Continuing with the basic concepts. In the previous video, we learned about classification of goods, that is the capital goods and the consumer goods, the stocks and flows, and depreciation. Here we are going to learn the industrial classification. Industries or production units are divided into three sectors: the primary sector, secondary sector, and the tertiary sector. The primary sector exploits natural resources of land, water, and soil. That is why it is called as a primary sector, because we directly get the materials or goods from the nature. The activities in the primary sector include farming, mining, forestry, fishing, animal husbandry, etc., which are directly related to the natural resources. These provide raw materials for the secondary sector. Now the secondary sector converts these raw materials obtained from the primary sector into finished goods. That is why it is called a secondary sector, because it goes one step ahead of the primary sector. So it converts those raw materials into finished goods, and it includes the manufacturing sector. The activities under the secondary sector include factories, construction, power generation, water supply, and so on and so forth. Then the tertiary sector. It is otherwise called the service sector because it produces services. It depends on the secondary sector as well as the primary sector. The activities here include transportation, trade, education, finance, hotels, tourism, administration, etc. Now, why I said they depend on the secondary and the primary sectors is the transportation is the tertiary sector, the services sector. So it transports raw materials obtained from the primary sector into the factories or construction sites. So it comes under the secondary sector. So it provides the services, and hence all of them are included under the tertiary sector, and the tertiary sector depends on the primary as well as the secondary sectors. Now the goods and services produced above in the primary, secondary and the tertiary sectors have to be sold in the market. So the government imposes taxes on the sale of goods and services. This tax imposed by government on goods and services is what we all know as GST, or Goods and Services Tax. This tax increases the market price of goods and services. So suppose the price of the good after it is manufactured is ₹10. So by this addition of the goods and services tax, which we are calling as indirect tax, it increases the price from 10 rupees to, let us say, 12 rupees or 14 rupees. It could be anything depending upon the margin or what the tax is incurred on the particular good. So it increases the market price of the goods and services. Market price means the price at which we are buying the commodities in the market. Then there is another concept called subsidies. In this case, financial or economic assistance is given by the government as part of general welfare or social welfare. If indirect tax increases the market price of goods and services, subsidy reduces the market price of goods and services, because here the goods are manufactured at a very low rate or less rate. So they will be available in the market for a lesser price. For example, the subsidy on the LPG, this is what we commonly know. Now the others are interest-free loans to firms. Interest-free loans to firms also would mean that suppose there is a firm that wants to set up a factory in a backward region. So the government would support it, because that will help the increase the economic status of the people in and around that region where the factory is going to be established. So the government provides them subsidies. Okay, so at a lesser rate they can establish a firm. Therefore, the net indirect tax would mean the difference between indirect tax and subsidies. Now, indirect tax is imposed by the government and subsidies are reduction in the prices of the manufacturing units or the goods that they produce. So, difference between them would give us the net value or net indirect tax. Now, the market price means the price at which the consumers buy goods and services, or the price consumers pay for goods and services. This includes indirect tax. And that is why the market price goes up when indirect tax is added. Then we have the factor cost. Factor cost means the prices of products by producers. That means that which is distributed among factors of production. Now, what are the factors of production? We learned land, labor, entrepreneurship and capital. So, on these we receive some income, factor income. On land we receive a rent. For labor there is wages and salaries, isn't it? So, for capital there is interest, and entrepreneurs there is profit. So, these are the factor costs. These factor costs are distributed among the factors of production. Therefore, the factor cost would mean market price minus indirect taxes plus subsidies. The factor cost includes all these. So, the factor cost would mean market price minus the net indirect tax. What is a net indirect tax? It is indirect tax minus subsidies. That gives us the net indirect tax. So, factor cost would mean that after removing the taxes, whatever is the cost would be the market price. In other words, factor cost plus net indirect taxes gives us the market price. Then we have the inventory. What is inventory? It is a stock of unsold goods. The stock of unsold goods would mean that it could be finished goods, semi-finished goods or raw materials which a firm carries from one year to the next. That's called as inventory. This inventory is measured at a given point of time. And what did we learn this? That which is measured at a given point of time is called as stock. So, inventory is a stock variable. The next is change in inventory or net change in inventory. Net change in inventory would mean closing stock minus opening stock. Now, change in inventories takes place over a period of time and hence we are calling it a flow variable. This inventory is treated as capital. This inventory is treated as capital, and the change in inventory is treated as investment because it is addition to the stock of capital of a firm. Addition to the stock of capital, and hence it is a flow variable. Now, there is something called unplanned accumulation of inventory or planned accumulation of inventory. In case of an unexpected fall in sales, if the sales fall, then the firms will have unsold stock of goods which it had not anticipated. So, there will be unplanned accumulation of inventory or stock of inventory. Okay. So, planned accumulation would mean that the firm wants to raise the inventory from a certain number. That means it is able to sell a certain number of goods in the market. Now, it wants to increase its inventory, so it will increase the production also. But by the end, what happens is, as planned, it will not be able to sell all the goods that it has produced or units of the good that it had planned to sell. So, that is called as planned accumulation of inventory. Okay. So, that is the difference between planned and unplanned stock of inventory.